Hi, this is Kevin Gormley, CPA that does financial planning, and today I'm going to talk about good stock, bad company, good stock, good company, maybe bad stock. And this is coming from William Bernstein. And so William Bernstein asks the question, are good companies necessarily good stocks? And he comes to the answer of no. But let me tell you a little bit about who William Bernstein is and the impact he's had on my investment life and my financial life. He wrote a book called The Four Pillars of Investing. Now, William Bernstein, the reason I like him so much is that he is a neurologist, a PhD, and then after many years in neurology, he started his second act, being an investment person and understanding, an author more so than an investment person. But he is incredibly smart. He looks at things from an evidence-based approach as a neurologist. He wants to know what the evidence is. And he said it was laughable about how many smart doctors that he knew that were very poor investors. And not because doctors are dumb, but we're all dumb when it comes to investing. And so if you're a client and you say, well, I don't want to learn this stuff, this is not important to me, that's why we've hired you to do our investing, if that's us or someone else, I would suggest that if you don't understand at least basic understanding of the four pillars, you will have a difficult time sometime, even if you're using somebody. The story of the person who's fired 4 advisors because none of them know how to make me any money. Well, it may be because the client doesn't know how to make themselves money. And it doesn't matter what the plan is if when markets do what they do, which is unpredictable, and clients quit, well then every time a client quits, they end up selling low. So anyway, the theory of investing, the history of investing, the psychology of investing, and the business of investing. Those are the 4 pillars. So today, let's talk about good stock, bad company, good stock. So this comes from the Investor Manifesto that William Bernstein, his most recent book. And he talks about Gene Fama looks for angels and finds none. Well, Fama and French and many other people that have done data looking back in history to try to find if you can pick winners. And Fama and French came out with the 3-factor model, which is something that we very much believe in. But what they tried to do is find winning strategies. And so they said, can we pick stocks over periods of time? And what they found is that no. You can't pick stocks. Just because a company is a good company does not necessarily means it'll be a good stock. As a matter of fact, the opposite has actually been shown to be true. So this is from their data as well as the data of others. So this is the first point that Dr. Bernstein makes. Just like people, most companies given enough time die. And he says paradoxically over a 10-year time period, about 2/3 of stocks underperform the market. Most market returns come from relatively few companies that succeed mightily, such as the 115-year-old General Electric. So over a 10-year time period, 2/3 of all the stocks do worse than the market. This is the reason why you don't buy stocks. And even if you try to buy good companies, 2/3 of them do worse than the market. Okay, here's about a 30-second math as well as investment lesson here. Growth companies are companies that are growing fast. They may or may not have tremendous profits, but they are loved. People think they're going to grow. People buy them because they're going to grow. The annualized returns going back to 1926 for these growth companies, and this kind of goes against what Dave Ramsey says, buying large cap growth stocks. They've actually had a 9% return. These great companies of America have had a 9% return. Now, when we go to value, the word value sounds good, and they made it this way because they want to say buy stocks that are a great value. But small value and large value are the companies that are less bought, less loved. They expect to grow slower than these growth stocks. These are the companies that people don't want as much. And yet the good stocks here, the good companies here, tend to be worse stocks, lower return. And the bad companies, or the companies that are less loved, tend to have higher returns. And so It says, what amazes and perplexes many investors, including professionals, is the fact for both small and large stock that slowly growing doggy value stocks have had higher returns than rapidly growing glamorous growth stocks. How do value companies tend to outperform growth in the stock exchange when they manifestly do not in the consumer marketplace? I mean, the companies that dominate in the marketplace yet have lower returns, but what, again, the scientific-minded Bernstein says very simply because they have to. Think about it. If you buy Ford and have the same expected return as Toyota, who in their right mind would buy Ford? And this was written back again in 2008. So in order to attract buyers for its far riskier stock, Ford must offer investment people a higher return than Toyota. So what he's saying is this whole idea of buying great companies and expecting them to be great stocks. What's his name from Fast Money, Mad Money? Jim Cramer says, buy best in breed. Well, buying the best in breed does not typically produce the best results. Now, this is in groups of companies. This is not individual companies. But this is what makes investing so difficult and the reason why I do not recommend you or I ever buy individual stocks. If you buy the great companies, they may already be very highly priced. And so that's why we recommend buying markets and not buying companies. And he says that while you might not want to put a large amount of your net worth in a single company, the law of averages dictate that owning a large number of lottery ticket companies should produce enough winners to make up for the majority of eventual deadsters. So what he's saying here is that if you buy a group of companies, the winners will make up for all the companies that are losers. And we're talking here in the value area. So Fama and French's data, the first study they published was back in 1992 on this small effect and this value effect. And they both mean less popular companies. The more popular a company it is, the more money flows into that company. Like you can measure how much people invest in a company they love just by the fact that everybody owns it and there's lots of money invested in it. Companies such as Apple, everybody loves it, so they invest tremendous amounts of money in it, and so its market cap goes way up. And so the neat part about the Fama and French data is that it's been shown to be correct, not just in the U.S., but also they've now shown it in Europe, the Far East, as well as emerging markets. And so good stock does not mean good company, and good company does not mean, or bad company does not mean bad stock. And so this is the whole reason why I recommend, once again, not to buy stocks, but to buy markets and to go ahead and tilt your portfolios towards value as well as small. Still own the large stuff, still own the glamour stocks, still own the good stuff, own the good companies, but own some of the bad companies as well. Totally counterintuitive. And when you tell this to people, they sometimes get very offended, especially if they own a group of the top 20 stocks in America and they're all the great companies, and you say that's a bad idea. They can get very offended. But this data shows that you want to own things that are on sale. Thanks for listening. I'm Kevin, a CPA that does financial planning.